Welcome back to our discussion on accounting. This series, this section, we are talking about the normal balances of accounts, whether they have a debit balance or a credit balance. So this is a continuation of what we've talked about in prior sections. Recall that when we talked about various accounts, we said that the balance of any account it's either going to fall on the debit or credit side, and it's always going to fall on the side that has the highest balance. So in this case, we have 100 plus 300 debits, so we have $400 of debits and $350 of credits. So we have 50 more debits dollar-wise than we do credits. So the balance of this account, whatever it is, whatever the name of the account is, it's $50 on the debit side because we have $50 more debits than we do credits. Again, it doesn't really matter what this account is. We know there are 50 more debits than credits, so that is the balance. This other account here, again, we don't know what it is. So here we have, if you add these up, we have $150 worth of debits and $300 worth of credits. So we have 150 more on the credit side than we do on the debit side. So the balance of this account is 150 credit. Again, we don't have a clue at this point what type of account this is. It doesn't give us the name. Because of that, we don't know what type of account this is. Therefore, we can't really tell whether this $50 debit balance or this $150 credit balance, we can't tell whether that's positive or negative. The only thing we know is that it's a $50 debit balance and a $150 credit balance. That's all we can say at this point. It may be positive, maybe negative. We don't know. To know this, we first have to know what type of account it is, and then we have to know what the normal balance of that account classification is. Once we know the normal balance of an account, that tells us what we need to do to increase it. That tells us what side it should be on in order to be positive. If it's on the other side, that means it's a negative balance. So just as an example, if a specific account has a normal debit balance, and for whatever reason our balance ends up falling on the credit side, the opposite side, that's a negative balance. So once we know the normal balance of an account, we know how to increase it. We use that normal balance to increase it. So if it has a normal debit balance, then we debit that account to increase it. If we credit that same account, it's going to decrease it. So to understand the normal balance rules, we have to go back to the basic accounting equation where we said that assets equal liabilities plus equity. This is one of those equations in accounting that has no exception. It's the fundamental, it's the basis for double entry accounting that we're talking about. So assets, the things the company owns, the resources, that equals the liabilities plus the equity. In other words, the claims to those resources. If the company has assets, somebody is going to have a claim to those assets. Some of them will be claimed by creditors, and that's because we borrowed money to buy those assets. The other amount, whatever's left, would be claimed by the owners, assuming there's something left. So assets equal the liabilities or the creditors' claim to those assets, plus the residual claim, which is the owner's claim to those assets, whatever's left. So the resources, another way of looking at this is the resource has to equal the claims to those resources, or you can think of it as the resources equal the methods of financing the purchase of those resources. Where did we get the money from? Did we borrow the money, or did owners invest their money into this company in order to allow us to buy those resources? So we can break this down a little further. Of course, we could have several types of assets. We could have several types of liabilities that we owe. But owner's equity can be broken down into different classifications. We first start off with two main classifications of owner's equity. The first one is contributed capital, which just means owners have invested money into the company. It's what they paid when they first bought the stock. It's not talking about any changes in the stock value over time. Instead, it's just talking about the initial contribution. Sometimes this is referred to as paid-in capital or common stock, but we also have other types of stock that would fall under here. This comes up in later discussions. So we have contributed capital. plus something we can call earned capital or just retained earnings. Retained earnings is basically all the net income this company has ever earned minus any amount that they've paid out in dividends. This is an accumulated balance from the start of this company's life. So to get this ending balance for this particular year, we start with the beginning retained earnings, which is last year's ending balance. We add in net income because we're earning more earnings, obviously. And we subtract out dividends that we paid out this year because that reduces retained earnings. Now notice this is red. This is all these items in red are going to be the individual account classifications because they can't be broken down any further. Then net income we can break down further. Revenues minus expenses. So it's either a positive number or a negative number depending on whether we had more revenues or more expenses. So again, pay attention to what I have bolded in red here. Assets, liabilities, we'll just say capital, contributed capital, revenues, expenses, and dividends. These are the 6 major classifications of accounts that you need to know. There are some other special ones that come up from time to time, but these are the 6 major ones that you have to understand to be able to understand the normal balance rules, which we're going to talk about right here. So remember that we have that accounting equation. Assets equal liabilities plus equity. And we can break down equity again, but we'll see that in just a bit in the next slide. First, let's look at the main rules for the 3 big account classifications: assets, liabilities, and equity. Remember in that equation that assets are on one side, liabilities and equity are on another side. So they are going to be opposites. They are balanced out. So they are on opposite sides. They have to balance out. Because of this, the normal balance rule for assets is the opposite of the normal balance rule for liabilities and equity. And when I say equity, I'm talking equity overall. We will see equity broken down in a bit. So the normal balance rule here is that an asset has a normal debit balance. It's increased by a debit. It's decreased by the opposite, a credit. Liabilities and equity have normal credit balances. See them in green. That means they are increased by credits and they're decreased by the opposite, by the debit. So you can see how this is opposite. Assets are on one side, they have one rule. Liabilities and equity are on the other side, and they have the opposite rule. So here's the rule again for equity overall. It's increased by a credit, decreased by a debit. Now let's break that equity into its 4 main components to see how those rules come into play. Capital, or contributed capital, or paid in capital, whatever you want to call it, and revenues, they both increase equity. The more capital we have, the more equity we have. And the more revenues we have, the more equity we have. Revenues flows up to net income, which flows up to retained earnings, which flows up to equity. So capital and revenues, they have a direct correlation and a positive correlation to equity. So they're going to have the same normal balance rule. They're both going to be increased by credits, and of course they're decreased by the debits. So the normal balance of capital or revenues is credit. Notice I have a minus sign in front of expenses and dividends. As we increase an expense, we decrease net income, we decrease retained earnings, therefore we decrease overall equity. Because of that, it has the opposite normal balance rule from equity overall. Expenses have a debit normal balance, which means they're increased by a debit, decreased by a credit. The exact opposite of equity overall. The reason this works is that as you increase an expense with a debit, that same debit basically reduces equity. Dividends are largely the same. They have the same basic impact. They have a normal debit balance because as you increase a dividend with a debit, you are decreasing retained earnings and you are decreasing equity. So the same debit that increases a dividend in turn decreases equity. So one important note that I'm going to bring up a few times because it's so important to understand. It's one of those things in my first accounting course that caught me for a couple weeks. Dividends are not expenses. Even though they act in very similar, they have a similar relationship to equity as a expense, dividends are not expenses. The reason is they do not impact net income at all. They skip right past net income. Expenses reduce net income. Dividends have no impact at all on net income. You'll never see a dividend on an income statement. Instead, they go right past net income and they directly impact retained earnings. They reduce retained earnings. Yes, an expense ends up reducing retained earnings as well, but it first has to go through net income. So we saw the arrows, we saw the pluses and minuses. That's one way to learn the normal balance rules. The way I learned and the way that sticks with me to this day is the normal balance mnemonic. So if you want to learn what accounts are debit accounts, what accounts are credit accounts, use these two mnemonics. DEAD, D-E-A-D. That tells us that the debit accounts for D are expenses, assets, and dividends, sometimes referred to as drawing if it's a sole proprietorship. So again, the debt accounts tell us that the debit accounts are expenses, assets, and dividends. D-E-A-D. It's a nice word there. The next word, it's not really a word, it's just it's close. You can pull a word out of it. C-L-R-C. You can say clerk, Clark. Sometimes you can think, hey, accounting clerk. When you're going through accounting, sometimes you think that accounting and these normal balance rules will kill you, but of course it won't. So dead for the debit accounts, clerk for the credit accounts. C-L-R-C. The credit accounts include liabilities, revenues, and capital. So in this case, cash. It's an asset. It's a resource we have. It has a normal debit balance. So here we have 500 total debits, 350 total credits. Our balance is $150 on the debit side just solely because we have more debits than credits. Now, fortunately, we want it to be on the debit side. It's an asset. It has a normal balance of a debit. So this is perfect. That tells us it's $150 positive, because it's on the proper side. It's on the normal side. Now, on this account, we have $700 on the debit side, $350 on the credit side. So our balance is $350. We have $350 more debits than we do credits. So our balance here is, again, $350 debit, which is positive for a cash asset account. Here, we've added in another transaction on the credit side. So we still have $700 debit, but now we've added $200 on the credit side, so we have $550 total. By adding this credit in, we've reduced our account balance because there's less of a difference between debits and credits. Now our balance is only $150. Now in this case, we've added yet another credit. We still only have $700 debit. Now we have a total of $750 credit. The balance is $50 on the credit side because solely we have $50 more credit than we do debit. It doesn't matter what account it is. We have $50 more on the credit side than we do the debit side. Therefore, it's a $50 credit balance. Now here's the problem. Cash is an asset account that has a normal debit balance, but our balance now is on the credit side. It's abnormal. That tells us we have $50 negative for cash. Not a good place for a company to be. That means pretty much they bounce their check. I'm going to bring this up one more time because it is so important. Dividends are not expenses. They do not impact net income. They go straight to retained earnings, and they do reduce retained earnings. So let's take a look at a journal entry here. We have, and this is what a journal entry would look like. We have the date, we have the transaction or the accounts impacted, and then the amount. So you're always going to have your debit first, or debits. You may have plural. You may have more than one. And any credits you have will be second. They'll be indented to the right. So here we are debiting cash for 100, which increases it because that's its normal balance. A debit is the asset's normal balance. When we credit revenue, we're increasing that because a revenue has a normal credit balance. So in this case, we are debiting cash for 100, which increases it. It's an asset. Accounts receivable, AR here, is being debited 150. It is also an asset, so that increases that as well. Revenue, again, is being credited by 250. Revenue has a normal credit balance, so that increases the revenue account. Remember the rule that our total debit dollar amounts for any journal entry have to balance. It doesn't matter the number, the quantity, it's the dollar amount in total. $250 worth of debits equals $250 worth of credits on the revenue, so we're fine here. We're in balance. So here is another thing that struck me as odd my first couple of weeks of accounting. It's an important thing to get to understand. We said cash is an asset. Assets have normal debit balances. Debits increase assets because of that. And then the opposite, the credit will decrease the asset. So debits increase cash, credits decrease cash. So the question here is, when you look at your bank account register, your checking account register, we'll see that in the next slide, you'll see that under the deposit column, it actually says a credit. And under the withdrawal side, it says debit. That seems to be the opposite of what we just said here. Debits increase assets. Here it's saying that the debit is treated as a withdrawal, which decreases the asset. So how does this reconcile? So here's what I'm talking about. The payment or withdrawal is a debit. It's a minus. The deposit is a credit, which is a positive amount. It's an increase. So that seems to be the opposite of our normal balance rules. The reason for this is that when you're looking at that bank account register, that's not your cash account per se. Instead, it's the bank's account. They're setting the account up for you. Yes, it's your money, but it's their account on their books. It's their liability to you. The bank owes you money whenever you put money in. Whenever you deposit money, that means they owe you more. We know that liabilities have a normal credit balance. So the credit increases the liability. When you deposit more money into the bank, your bank account register said that's a credit because they're crediting the liability to you. They are increasing their liability to you. The debit decreases the liability. So when you withdraw money from the bank, again, that account register says the withdrawal is a debit because you're reducing the bank's liability to you. They don't owe you the money anymore because you took it out. So hopefully this helps to explain the journal entries, the normal balances. I will see you in the next section. Thank you.